Good morning. I'm Jim Spencer. I'm with the Bluefield West Virginia Economic Development Authority, and we thank you for being here for the ones in the room, and then also the ones that will be watching later and participating by Zoom. You know, one of the things we've always tried to do is provide meaningful information. In today's class, Ms. Kim Donahue with the SBA and Harold Patterson, who is with the West Virginia Small Business Development Center, will be talking for a while about funding for your business. And if you have any questions, if you're online, you can drop it in the chat. We appreciate their time, and the goal again is to strengthen our small businesses in the area. So Ms. Kim, thank you for coming down and being with us today.
Thank you, sir. Happy to be here. If you're online or if you're in here with us in this nice computer room, there is a systemic capital access gap. We know that small business ownership is good for the U.S. economy. It's good for West Virginia. It's good for Bluefield, but it's harder and harder for certain folks, the smallest of businesses, to get capital. Now that not just small businesses, but includes small businesses that are women-owned, minority-owned, and in rural areas. So there has been an expansion of those financial services online, but there's so many of them, and from different groups and organizations, and it can be a little confusing. So today what we're going to do is, with some input from Harold, thank you, Harold, is we're going to talk about the importance of planning. We're going to spend a very short amount of time on that. A little bit about what a traditional lender like a bank or a credit union or a microloan entity, which we're going to talk about those too, what they want to see in a loan application. We're going to spend most of our time talking about financing sources and options. And then we're going to end it with talking a little bit more about credit, both your personal credit and your business credit. Those things really matter in terms of accessing capital. So in planning for a healthy business, the great meme that I like to use is a failure to plan is a planning to fail. And it's no more true. It's especially true when it comes to business planning. Not only does the planning process help you convert this vague idea into something more solid, into a plan. If it's good, it's going to motivate potential lenders, or as they call them, stakeholders. It's going to motivate them to be more likely to loan to you. And it's also, at the end of the day, going to save you some time and money. But, you know, what is success? That process is going to help you determine that. Now, there's a 4-step planning model. This is actually from Federal Deposit Insurance Corporation's Money Smart series, but I like this. And so the preliminary research that you do is maybe your step 1. And one of the things that you should also do in that, and there's lots of online tools for this, but it's doing a little bit of a self-assessment. And sometimes it's not about being a self-assessment so much as about assessing your family. Because if you're a small business owner, your family's part of that business, whether they intend to be or not. So are they on board? Are they on board with you working weekends? Are they on board with you working late at night, et cetera? Now, when it comes to developing a resource plan, pulling that more formal business plan together, starting looking for financing, and, you know, staying on top of everything and turning that business plan into an action plan, you're going to need some help. And that's what SBA Resource Partners are here for. We have not only Harold, who's here with us today, but there are women's business centers, SCORE chapters, veterans business outreach centers, and you can actually find all of those. I think I've got a link for that later on coming. But those organizations, as well as your local economic development authorities, or like the Bluefield Economic Development Authority, they're here to help. They have a lot of the data that you're going to need, and they have the skill set that you're going to need. You're going to need that expertise. So what a lender wants. Let's start someplace important. This is what I call just a reality check. Most small businesses, this is from SBA's Office of Advocacy, most small businesses are going to use personal savings to start their businesses, about 75%. Now, the second highest source of funding, about 20%, are banks. One word you're not going to see on here are grants. Grants are few and far between, and for the most part, government entities, I'm going to say really for all part, government entities do not provide funding, direct cash, for a business opening or business expansion. Now, sometimes there are things that are listed as grants. It could be a business plan competition, a pitch competition. And even then, it may not be hard cash. It may be access to services. It may be technical assistance, like helping you with your accounting software or something like that. So when somebody says they have a grant for a small business, be very wary about that. All right, number one, what a lender wants to see is equity injection. Now, the phrase that's been rolling around in my head for probably at least the last 5 years is there's no such thing as 100% financing. What that means is that lenders want to see your, as they call it, skin in the game. Because the more that you have at risk, the more likely you are to repay the loan. And how much is going to depend on not only the lender and their standards, but it's going to depend on you and the business industry that you're in. Now, lenders can require anywhere from, in my experience, anywhere from 20% to up to 35%. And the range is really just going to depend on you. So for example, if you have a business project that's going to be $100,000, 20% equity injection required, you're going to have to come up with $20,000. And that's primarily in cash, right, Harold?
Primarily, yes.
Collateral. Now, collateral are the physical things that you have, and it's just those items or real estate or buildings that are going to satisfy the debt if something happens and your business goes belly up, in case you go into default. If you have that collateral, it's actually considered a secure loan, and you'll actually get better loan terms. Now, what happens is that the lender will take a lien against that collateral. Now, there can be specific liens, which is, let's say it's against a backhoe or a truck, something like that. Or they can do a blanket lien, which we're saying it's a lien on all of the assets of the business. And more than one lender can have access to that collateral. There's something called superior and junior liens. It gets a little complicated, but just know that the lender, when it comes to collateral, they are going to file what's called a UCC. It stands for Uniform Commercial Code, a UCC-1 form, and it's going to be filed with your Secretary of State's office. And it's going to be a message to any other lenders who are looking at a project with you that, hey, we already have this collateral tied up with a lien. Now, there's a little trick to this, and it took me a while to figure this out. And let's say I have a list of assets here, and I think it's, worth $50,000. Well, what banks do is they have some formulas in place, and they're going to discount that. So if I think as of today, my collateral has that value of $50,000, banks have formulas they're going to use to anticipate what the future value of that collateral is. It ranges from the type of collateral that you have, whether, computers, office equipment, et cetera. I do know that the average is, when it comes to real estate, that basically it's going to be discounted by about 80%. So, you're going to see, they're going to say it is 80% of its current value, because that is their anticipated future value. Personal and business credit, we're going to talk about this a little bit later, but really both are important. I talk to a lot of folks, and Harold, I'm sure you do too. They say, well, my business credit, I've been in business for a couple of years. My business credit is great. My personal credit is terrible. But the younger your business, the more important that personal credit is. So you really need to have both of those things in place. Credit scores. That's how your lenders assess, whether to extend credit to you, how much credit they should extend to you, and it helps them establish the interest rate. The better your credit score, the less you pay for the funding that you need. Now, if you need to build up your credit score, think about, you can go to consumerfinance.gov. It's a federal site, but it's very good, and it can be a starting point to helping you clean up your credit report, et cetera. And also annualcreditreport.com. And I'm going to talk about more of that in the future, but it's where the 3 primary commercial reporting agencies have to provide you, as a member of the public, the credit report, not the score, but the report at no cost, at least once every year. Repayment ability. Now, this is interesting, and they look at it in a couple of different ways. If you're a startup business, they're going to look more at your debt to income ratio. And that's basically, this is simple, your monthly payments that go out divided by your gross monthly income. So if I have payments in my personal life, mortgage, car, et cetera, of about $1,200 a month, and my gross monthly income is $4,200 a month, that means I have a debt to income ratio of 28%. Your goal is to get that at 35% or lower. So in that case, the lower you are, the better you are. When they do a similar calculation with the business, they'll do what's called, now there's other formulas that they can use, but these are the two primary that I think are the easiest to understand. But they'll do a debt service coverage ratio, and they'll take the net operating income of the business, and they're going to divide that by the total debt service. You know, what kind of debts are you paying on? And the good thing is, you know, let's say you've got net operating income of $5,000, but you've only got $4,000 going out in debt payments. That gives you a DSCR of 1.25. The goal is to be at 1 or higher. Now, when it comes to the loan packaging, again, this is where you're going to need some help, because it's not a science, but it's more of an art, and it's going to be different depending on the industry. And I think, Harold, you would back me up there.
Yes.
But you'll need when we talk about the loan package overall, it's going to be your business plan. And that business plan will need to include your business financial statements, not only current year to date, but 3 years in the past. Your personal financial statement, and that's typically a form that you fill out. I know SBA has their own that they use. They're also going to need not only your personal, but your business taxes if you've been in business for 3 years, and really hang on to those taxes. They're also going to want to know the source and the amount of that equity injection, that equity contribution we talked about originally. And then, of course, they're going to pull up your credit report. The other thing they're going to want to list to you is, remember we talked about the discounting. They want a list of all of that collateral and the fair market value. That's what you think it is. But at the same time, what's going to happen is they're going to apply their own formulas. And if you are starting a business and you already have some contracts in place, or you've got appraisals on that equipment, maybe you've got purchase agreements, estimates of equipment that you want to buy, those should all be included in that. Am I correct, Harold?
Yes.
Okay, good. Now, disqualifications. What will keep you from getting your foot in the door? Sometimes with many lenders, it's going to be bankruptcy that's newer than 2 years, more than one bankruptcy, or occasionally a bankruptcy that's caused by something other than, let's say, health bills or maybe a divorce, which we know are very frequent. Slow payment history, that low personal credit score, non-payment of student loans, and another one that most folks don't think about is unpaid child support. Also, again, the business type and the risk level that those business sectors have all go into that. I will tell you that the default on any government loan, including a student loan, is just it's a stopper from the very beginning. All right, here's why we came: financing options and sources. Now, each of them have some advantages and disadvantages, but just kind of keep in mind that it's suggested that you borrow no more than 200% of the money that you are going to be investing in your business. So it's not a hard and fast rule. It's just a recommendation, but it is something to keep in mind as you're building that business plan. As we said earlier, gifts, maybe we said, 75% comes from your personal savings, but there's also gifts. I call it, Uncle Bill, he's a little richer than I am. He's got a $5,000 he can throw at me. He can either give it to me as a gift, or I can get it as an informal loan. Now, if it's a gift, it's not as simple as you think as, hey, he puts $5,000 in my account. It gets a little more complicated than that because your lender is actually going to see where that money came from, and they want to guarantee that it's already in your account. So when it comes for gifts, that's important to remember. You're going to have documentation to source that gift. Informal loans, you're also going to need to document those, but the important thing to remember when it comes to informal loans that you're going to be paying back, it really needs to be part of the cash flow of your business. So you need to have that informal loan listed. The only exception to that, let's say that informal loan is going to be paid back through another source. It may be your spouse's salary. If that's the case, they're still going to want to know what your spouse makes, and if he or she is going to be making that payment and how much, et cetera. So, they're always doing a deep dive into your life because lenders have to be what they call prudent. And there are lots of regulations around it to make sure that the banks are secure. And so prudent lending practices is a phrase we hear over and over and over again. Now, terms or installment loans, this, you go out and buy a car, you pay it back, you pay a little interest every month, and you just get this one big disbursement. It's usually used, as I said, to finance an asset. And many times these will have penalties for early payments. So you need to kind of keep that in mind. Lines of credit. I've used these before and I've misused these before, but it's used to finance an additional business expense that comes up. So for example, let's say I'm working as a contractor for a bigger company and they only pay every 90 days on their invoices. Well, I have to pay payroll every 2 weeks. A line of credit can make sure that I've got that cash in hand to make payroll. And then when the invoice is paid from that big business or other business, then what happens is then I will then repay back that line of credit. Now, we have had situations where the big check, the invoice comes in and you just put it in the regular bank account. Done this before, not realizing, not thinking about it when I was much younger. And what that does is you've got the lender out there saying, wait, we're not going to renew this for you because you're not using it properly. So just because it's in your account and just because you have this loan doesn't mean it can't be taken away, particularly those lines of credit. They are going to be monitoring you to make sure that you're performing as you're supposed to with that financial product. Accounts receivable financing there's a couple of ways to think about this. The newest form is called factoring. And this is something that I started to see a lot of 2008, 2009. Remember the Great Recession? Businesses started selling their accounts receivable, their invoices, to what they call a factor firm. And the advantage of this is that the lender or the factor businesses, they're really not interested as much in your credit and your credit score, but they're interested more in your customers' credit worthiness. Now, this particularly works well for like wholesalers, distributors, drop shippers. There's usually no long-term contracts, but there's a couple of things to keep in mind. You're going to need at least a 25% profit margin. And somebody like Harold with an SBA resource partner can help you figure that out. But you need a really, really solid profit margin in there. I've seen factors being used by a lot of truckers, but if they don't have that profit margin built in, it can just get them into more trouble. So keep that in mind, because a lot of the factor companies, they'll take what they can get. And sometimes it's for industries that maybe are not appropriate for it because they don't have a big enough profit margin. Inventory financing, this is, think of your car lots, your boat dealerships. They can go in and what happens is they'll take a loan on this. This is not for every small business, but the inventory that you're going to purchase serves as your collateral. And this is a good case well, this is good if you're buying inventory and you may not sell it for 6 months or 3 months or 5 months. So when it comes to inventory financing, that's what you want to be, that's the example you want to think of. And it can either be short-term or revolving, depending. Leasing. Now, a lot of people wouldn't include leasing in financing a business, but I think it's a good source of getting equipment. at sometimes a lower cost. There's two different types. There's actually more than two different types of leasing, but the ones we're going to come into contact with are particularly the finance lease. It's not really a lease. It's a financing document where you pay so many monthly payments, and at the end of it, you're going to have ownership of that, let's say, backup piece of equipment. There's also an operating lease, and that's where you don't have ownership at the end. The thing is, an operating lease is going to have lower initial costs. You're not going to have that down payment, for example. So an operating lease can also, those lease funds that you're paying out, it goes against your gross profits, and it can actually be a tax benefit, particularly when you are looking at equipment that may become obsolete very quickly. Now, backhoes, not necessarily. Computer equipment, yes, goes obsolete within 5 years. So you may want an operating lease if you're going to be financing your computers. Business cash advances. Now, this is one of my favorites too. Not because I necessarily like it or trust it, but it is a valid form of financing. These used to be called merchant cash advances. And in the last couple of years, they've sort of changed the name. But it's based on, you get loans based on your credit card sales. So what a business cash advance lender will do is they will take 120 days of your sales, credit card sales, and then they will loan you up to 125% of that. And they can pay you back in you can pay them back in a couple of ways. One is that you can just make, regular payments, but a lot of these want the payments automatically withdrawn from your account. So that could be on a weekly basis, that could be on a monthly basis, etc. And there are other business cash advance sources where they'll just take a percentage of your daily sales every single day. This is best for retails and restaurants, obviously, because they have more credit card sales than others. But at the same time, this can be very, very expensive. It's one of those things where if you can get a term loan or a line of credit instead of this, you may want to go for that because you don't have to have such a big profit margin built in. Rewards crowdfunding. Think your Kickstarter, think your Indiegogo, and all of those. This is really flexible financing. What it does, though, is, to me, on one side, it helps to build the buzz about your product or your service. Some of the best I've seen, let me take that back. Some of the best I've seen are maybe I've got a new watch that has GPS built into it. To build buzz, I can actually say, as one of my rewards for you contributing to my campaign, I'm going to send you a watch. But that's a big reward. So you have different campaign levels. It also helps you in terms of your marketing, expanding your following. The bad news is overall, there's a fairly low success rate. It's about 22%. And the costs are really interesting. Depending on how the platform takes their money, they can take anywhere between 4 to 9% of the actual money that you have gained. And the credit card processing typically runs at 3%, and that's normally extra. There's something called all or nothing campaigns. Kickstarter does this. Let's say I have a campaign and I need to raise $10,000. In an all or nothing campaign, if I only raise 9,000 of it, I don't get a dime. The alternative to that, and there are online rewards crowdfunding platforms that do this. If I have a $10,000 goal, then if I only raise 9, I can still get it. But the odds are you're going to pay a higher percentage. So that's where that 9% comes in as opposed to the 4%. Now, if you're going to do this, you need to do it and do it well. You have a better, like 105% better success rate if you use video. The best campaigns are around 300 words and about 30 days. 30 days seems to be the sweet spot for a campaign. Peer-to-peer online loans, these again started 2008, 2009. We started to see more of that. It would be like Harold or Jim or I, hey, I've got an extra $500. I'm going to invest in a peer-to-peer platform. And that platform then turns around and loans that money typically to a person and not to a business. If they do have a business option, that is going to look at, they want to see at least so much of a history. But even the personal loans, they're going to look at your credit score. Now, here's the thing to be wary of is the interest rates can run anywhere from 6 to 36%. That's what I've seen. The better your credit score, the less you pay. As with everything in life. So if you have a 6% credit score, you are categorized as low risk. I think they call those maybe like A or AA. Then you would pay that 6%. If you've got like a D credit score, that's where we're looking at 36%. However, depending on the platform, some of the things remain true. You typically get a fixed interest rate. The terms are going to run anywhere from 6 to 60 months. There will be an origination fee that you need to look out for, sometimes 1%, and I've seen up to 8%. But again, these are mostly loans for the person. And again, if they do have a business loan option, they're going to want a track record for that. Now, when it comes to using, let's say I'm going to borrow from a peer-to-peer platform for my business, and I'm using the personal. When I go to put that money into my business, I need to be cautious how I do that. So if you got a bookkeeper, if you have an accountant, talk to them about how that is done so that you don't pay additional taxes on that. In my experience, it's been better if I'm going to do that, I'm going to put it as a loan into my business. Because if you don't, otherwise, when you take, let's say, an owner draw out of the business, you're going to be paying self-employment taxes. So if you use it as I understand it, if you put it in as a loan, you can pay back that loan typically without those taxes. And if my CPA friend is wrong, I'm sorry. Here's an example of one, Prosper. You can get anywhere from $2,000 to $50,000. It's personal, 24 to 60 months. Their interest rate runs about 9 to 36%. But now look at that credit score. That credit score, a 560 minimum, that's not too bad. Typically, banks are going to look at 720 right now. Okay. So, and they're also speedy, 5 days. And again, watch out for those origination fees and make sure that you understand those. Oh, by the way, just because I threw up Prosper here, it's just an example. It's one of the olders, but that's certainly not a recommendation for SBA or referral. It's just an example. There are lots of these businesses out there. There's also something that there's online, you can see a lot of direct lending, matchmaking, and brokering. When it comes to direct lending, your local bank may say, I know my personal credit union does say, hey, you want a loan from us? Go online, fill out the paperwork and go forth and do good work. That's a direct loan from the institution that I'm dealing with. Sometimes, however, when I just Google small business loan, and what will come back are matchmaking businesses, matchmaking platforms. And what they do is they have a series of partners and they will pull in your data that you provide to them. They'll maybe do a soft credit pull and then they'll send it off to the final lender. All right. That's like a matchmaking service. There are some fees that go along with that typically, but they are, I'm going to say they're hidden. We really don't see them. SBA does have a matchmaking service. And if you go to sba.gov/lender match, there we go. I've got the link. Lender match. That's a way to participate in the matchmaking without any additional fees, et cetera. And the only lenders who are in lender match have been pre-approved by SBA. There's also brokering. Some businesses are so specific that you may need the assistance of a broker, a lender broker. And what that is, let's say it works almost like your personal mortgage. Some people go to a mortgage broker where they help you to define, who's the best for me. It works the same way in certain business sectors. The thing is, there is going to be at least a 1% and sometimes higher again, I think of it as administrative fees. So those are going to come into play. So you will pay more for a brokering service, but again, if it's what your business needs, that's fine. Anytime you go online, I mean, the fintechs have like quadrupled. That's what they're calling, online financial services business, whether they're selling you insurance or business loans, or they're just providing software or apps to help you handle your finances better. In the lenders, anytime online, you need to beware of predatory lenders. There are some warning signs. Interest rates that are significantly higher. If the fees that they're charging are more than 5% of the loan value. If for some reason they're not disclosing the annual percentage rate, they're not disclosing the full payment schedule, you're asked to lie on the paperwork. I mean, that's obvious. Or you're asked to leave signature boxes blank. Don't do those things. Compare competing offers and consider what's going to be the best for you. And that, again, that's where you go to Jim at the Bluefield Economic Development Authority. You go to Harold with the Small Business Development Center, and use that assistance to figure out which is going to work best for you. I almost left this out. Angel investors and venture capitalists, because I see so very little of it. Harold, same thing? Yeah, not much. Angel investors and venture capitalists, often they're pulled into the same, big pool, but they're a little different. There's some differences. Angel investors, again, they're looking for high growth, high potential businesses. It can be an individual angel investor, or it can be a group of individuals. I know there's one in Western Virginia called the Country Roads. I can't think of the rest of it. I'm sorry. But there is a group of angel investors in Southern West Virginia. When it comes to angel investors, they're looking for anywhere from 10,000 up to 200,000, but they want in and out of, 1 to 2 years. When it comes to venture capitalist firms, you're really dealing with a company. A venture capital firm. This is longer term, but they're also looking for companies with high potential and high growth. Most of the venture capital firms are going to be industry specific. We want to deal only with technology businesses, et cetera. They are going to take a larger portion of ownership. I've seen up to 50%. So keep that in mind. When it comes to how much equity, that's what we're calling it, equity, you should give up, how much ownership or control or shares that you should give up of your business. Here's a nice handy dandy formula I found that just use it as a guideline. So the investment money they're bringing in divided by the business evaluation, that equals the amount of ownership control that you should be prepared to give up. Again, it's just an example. Now, notice something important there, business valuation. My business then needs to already have a value attached to it. And that's a very specialized service. There are certified public accountants who do nothing but value businesses. So to have that business valuation, you need to be, this is really not for startups. I guess at the end of the day, that's what I would say. There's something called small business and investment companies, and those are part of SBA. They're private equity funds, but they're licensed by SBA because SBA then works with them to provide low-cost government-backed loans to them. We're lending it to an SBIC, and they have to ultimately pay us back. But because we're adding to the equity funds that they already have, it does make sure that they're investing in smaller businesses. Now, there is one in West Virginia. It's called West Virginia Capital Access Program. It's through an organization called the West Virginia Jobs Investment Trust. Now, the cool thing about working with this West Virginia WVCAP is that they do have accounting, legal, or financial services, what we call technical assistance. They have those services that they can provide. And so if you're getting particularly a public equity fund organization, ask about the technical assistance you can get, because the accounting, the legal, and the financial, even marketing occasionally, that's going to be very important to you. There are also special purpose loans, U.S. Department of Agriculture, and it doesn't necessarily have to be for ag. SBA has loan guarantee programs. There's also, if you can export either a product or a service outside of the United States, there are special programs for that. And of course, SBA disaster loans, which I'm really not going to be talking about. The thing about most of these loans is that they are guarantees. So what I wanted to do is do a quick detour about how loan guarantees work. In a traditional business relationship, you've got your lender and your borrower, that's it. And the risk is shared between those two. However, SBA and USDA, to some extent, also have loan guarantees. And what happens is the lender can then come to an SBA and say, hey, this is a good project, this is a good business, but it doesn't quite meet our bank standards. Remember that prudent lending standards? So as long as it meets SBA guidelines, SBA can, with your permission, guarantee that loan. And depending on the product, financial product, that can range anywhere from, I think, 50% for some, and up to, most recently was up to 90% for those export funds. And those originally run about maybe 75%. Yeah, that's kind of a decent guideline to keep in place. So that's how loan guarantees, say them.
Talk a bit about the part
Of the collateral part of the
whole.
Oh, yeah. You will have, the lender will have, remember we talked about the senior and the junior liens? The lender will have a senior lien, and then SBA will have a junior lien. And if something happens and that loan needs to be liquidated, the lender will get to take the first shot at it, and then they'll turn it over to SBA, and then they will using the National Finance Center, they will start looking to make the government whole on that. Is there something else you'd like to add, Harold?
The loans are collateralized.
The loans are always, guaranteed loans are always collateralized.
They take all the collateral they can buy.
Yes, that's an SBA thing. They'll take all the collateral that you have. This is really, I say risky business sectors, but you're typically going to need like an SBA guarantee for startup businesses, because there are banks out there who say it's too risky to work with startups. There are also businesses that are typically considered, low profit margin. I was surprised to see lawn and garden stores on here. Travel and accommodation, recreation services, real estate services, even companies that sell building materials. Those are low profit margin businesses. There are also businesses out there that have high failure rates. Restaurants, a lot of retail stores, anybody doing direct sales, construction, and trucking. There's other considerations that the lender will take into place before they request a guarantee. It may be that you are purchasing a piece of real estate and you need a longer repayment term. And SBA especially comes in with maybe you don't have that 100% collateral. And as Harold said, we'll take everything that you've got. That's not take it, but we will consider that collateral. So that is a term when the lender, that is a time when the lender will particularly ask for an SBA loan guarantee. There's also economic development districts, and there's less of this in West Virginia. There is more of this in other states. So they work under the Economic Development Administration from the federal government. I think we call them regional planning and development councils, but they will often have revolving loan funds. And there is a directory of these at that first link. When you get the PDF, all of these are going to be hyperlinked, so you'll be able to just click and go. The directory of those by state. So you'll just pull up your state and it'll tell you who they are, and then you can go to their individual websites to see if they have that. It is my understanding that West Virginia doesn't have any of these at the moment, even though they have been in the past. There is, however, at the state level, an economic development authority. It actually is just called the West Virginia EDA. They have not only direct loans, but they have guaranteed loans as well. So that is something that I will occasionally forget about them, but do not, because if you're building a business, that's what they're there for. So you may be better off with a state EDA loan guarantee than you are with an SBA or a USDA guarantee. There's also community development financial institutions, or CDFIs. These are usually nonprofits, and they're oftentimes purpose-driven. So I saw one that it wanted to do environmentally responsible business projects only. If you're not in West Virginia, you can actually go to the link for a list of all community development financial institutions, CDFIs. In West Virginia, there's only one CDFI, and that is currently Partner Community Capital. And again, they are a lender. They want a business plan. They want financial projections. They want your tax returns. They want all of that stuff that goes into a good loan proposal. At the same time, they're getting their money a little someplace else. And Partner Community Capital covers, I believe, West Virginia and North Carolina. There's also certified development companies, and these are a little different. What they really, my experience has been working with them in terms of the 504 loan program. Now, when I say 504, all that means it's in section 504 of the Small Business Act, or a subsection. And it's just the term that that's just our shorthand. What happens in a 504 loan situation is that it takes a bank and a CDC. So you've got your bank will be responsible for a percentage of the loan. Your CDC will come up with another percentage, and then you will come up with your equity injection. And that's typically when you're buying very, very expensive equipment or very expensive real estate, because using a 504 loan program means that you can expand that out. I believe that's up to 25 years, which is above what a usual term loan will give you. The CDC that operates in West Virginia primarily is the Regional Development Funding Group. They cover the entire state, but they're actually headquartered in Pittsburgh. And if you're in West Virginia and you're in the Eastern Panhandle, there is another CDC that covers that area. Wherever you are, make sure you follow that link and see what CDC is operating near you, but also read a little about those 504 loans, because they do have some additional requirements, including, as I recall, a job creation requirement, at least an estimate. Now, one of Harold's favorite things, one of my favorite things, are microloans. There are typically two sources. There are SBA microloans, and USDA has a series. And what we do is a nonprofit organization typically will apply and say, we want to open a microloan program because we need the smaller dollar lending in this area. Microloan means $50,000 or less. I'll be honest, the average I've seen in West Virginia has been about $15,000. That's kind of the sweet spots for them. Again, just because they're a microlender doesn't mean they're not going to want all that financial information just like a regular lender does, because they also have to be responsible, and they're responsible to a federal agency. Where these micro lending entities are is actually going to depend on where you are. Harold knows the ones locally. In West Virginia, we're talking primarily statewide, Wyoming County Economic Development Authority. It's in Wyoming County, but it covers the entire state. There's also the First Microloan of West Virginia and the Economic and Community Development Institute. First Microloan of West Virginia is out of the Wheeling area, but they only cover like the Ohio River Valley counties, including Kanawha. Economic and Community Development Institute is actually headquartered in Portsmouth, Ohio. It's part of a larger organization out of Columbus, but they also will loan, have microloans available for, it's almost the same territory, but basically the Ohio River counties. Because that's their coverage area.
In, Region One PDC has one, and they, Princeton,
Ritchie County?
no, Region One.
Oh, Region One Planning and Development Council. Good, good. And that's a revolving? That's great.
And first microloan comes to Beckley.
Oh, First Microloan comes to Raleigh County.
Yes. comes
Good to
down
know.
They've actually, gentleman's name is Tim,
Tim Jones.
came down and did a class for us sometime back.
Main contact is Tim James and the other person is Carol Jackson. And yes, they're very, very good. I threatened you with talking more about credit, and I'm going to, only because it can be, remember we talked about bankruptcies and delinquencies and all that. Credit can also be a non-starter for you. I get lots of calls from people who say, my credit is terrible. It's in the 500s. Can I get a business loan? Not easily. So we are going to talk about credit. It's a boring topic, and I'm sorry, but we've got to do it because you got to know this. There's personal credit and business credit, what we talked about before. The bureaus that report your personal credit, Equifax, TransUnion, and Experian. Typically in West Virginia, and as I understand it, I'm looking to you, Harold, they will pull from a TransUnion. And when it comes to your business credit, you're looking at Dun & Bradstreet, Equifax again, and what they call Experian Business. The business credit side, if you want to see what it is, or you want to see what your potential vendors or suppliers are, or even your customers, you're likely going to pay a fee for that. Now, Dun & Bradstreet does have a free version of that, but there's also ones that cost typically a monthly fee, and Equifax and Experian don't have any. There are more than these three business credit reporting agencies, but these are considered pretty much the top three.
On the free, did you mention a free version of Dun & Bradstreet?
Mm-hmm.
What, is there a limit on what information you can get versus the paid version?
Yes.
I'm sure it's got.
Yeah.
Because sometimes for us, we're working with a developer, and that's something I was wanting to do is Dun & Bradstreet on the developer themselves.
Jim was just talking about how you can look at one of these business credit reporting agencies to see, how stable the people that you want to work with, or maybe that you want to contract with. And that's a good idea. Always, that's a good idea. Which is most important at what time depends on the age of your business. If you're a startup, that business credit score is going to be more important. As your business gets older, that business credit is going to be more important. And when we're talking about very, very, very large businesses, they don't even, look at the owner's credit. But for us, for small businesses, they're going to look at both all the time. And they'll actually take whatever percentage of the personal and whatever the percentage of the credit, the business, and they'll combine them into like a global credit score. And again, there's more than these three: personal and business credit. There are multiples. SBA, I'm not sure which one they use at the moment, but every bank, every lender, credit union, et cetera, they're going to use a different one. So just because you pull out, hey, I've got a FICO score, that's very specific, got a FICO score of 720, doesn't necessarily mean that the score that they pull for you is going to be that same. Now, I almost started talking about this a little too early, but I talked about your personal credit, Equifax, TransUnion, and Experian. A number of years ago, Congress mandated that these top three, that once a year, they supply you a free credit report. It doesn't give you your score, but it does give you a report. What that credit report gives you is the last 7 years of your financial history. There's a lot of identity theft. I don't think I'm telling you something you don't know, but so it behooves you to pull that credit report and start looking. For example, my dad's name is Bill. He had a cousin named William. William stuff started showing up on Bill's stuff. So you have to be very careful and look at that. One good way to make sure that you are continually looking is that you pull Equifax maybe in January, and then you pull a TransUnion 4 months later, and 4 months after that, Experian, as an example. And then that way, throughout the year, you're seeing what's showing up on your credit report. Now, they may not always be the same. Something may be listed on TransUnion that's not listed on Experian, but it is a good way, number one, to make sure your identity hasn't been stolen, but two, that you're only having counted against you debts that are really yours.
What about Credit Karma?
I've never dealt with Credit Karma. Harold, why don't you tell us a little bit about Credit Karma?
Credit Karma is actually owned by Intuit, the QuickBooks company, and they are free to look at. You can set your own account up. They will give you a credit report basically anytime you log in. It's fairly accurate. I've seen it within 10 points of getting loans from what they reported to what the company that pulled the credit report actually gave the score. It's just a good way of tracking your accounts and making sure that there's nobody trying to open up a new account, because they do send you alerts and ask you, have you opened up a new account? So Credit Karma is actually a very good way to monitor what's going on in your financial world.
Thank you.
I've always heard the rumor that the more that you check your credit score, does that impact your credit score?
Yes and no. If it is what's considered a soft credit pull, remember we talked about the lender matchmaking. Those are typically soft credit pulls. They will not count against you. You looking for yourself won't count against you. What will count against you, I guess I can use the example of the first time I ever went and bought a car. And I gave them my information, my license, and they had, 3 offers for me to finance that car. The thing is, each of those companies had done a hard pull on me, and that actually impacts your credit score. I will tell you the number one thing that impacts your credit score, well, I've got it, is paying your bills on time. For your FICO score, that's 35%. And so if, let's say, your credit score is fairly low, if you just start paying your bills on time, you can raise that at least 20 points, within 6 months, less than 6 months. You should also keep those outstanding revolving balances fairly low. The guideline I've seen, it's just kind of thrown out there. 30%. If I have a $1,000 credit card, I should only, have it charged up to 30% of that. That number is kind of just a made up number. It's based on some solid information, but just kind of keep that in mind as a guideline. So, 30% or under. If you can pay off outstanding collection accounts, those are the first things I would pay off when they're, when you're looking at that. If you're doing a loan, comparison shop and do it within a 45-day window. That's one of the things that will make sure that they can see, oh, well, she's loan shopping. I will tell you, just as a personal aside, the last car, I told you about the first car, but the second car and the third and the fourth car I financed, I went to a lender first and said, how much can I afford on this car? And they were very good about it. And I actually had a check ready for me for the dealership and said, here's what it is. And so they weren't able to pull the credit. I didn't get those hard pulls, and that helped. They also grade you on the mix of credit accounts. So do you have a mortgage? Do you have a loan, a car loan? Do you have different store credits? So the better the mix of credit accounts you have, the better off you there. Also, I'd made this mistake as well. Don't pay off a credit card or an account and then cancel it, because that lowers your credit score immediately and by a number. I see you shaking your head. Yeah, it really does. So if you have a long-standing account, even if you're not using it, keep that open, use it once a month, once a year, immediately pay it back. You're still got a zero balance at the end of the month, but you also have the length of credit history, and that also goes into your credit score. How long you've had credit. So there are a lot of elements that go into that.
Let me ask a question for the folks that may be listening in the future. When my kids became adults, we bought them a car for college.
Mhm.
We borrowed the money in their name. And then we were making the payments as code because at 18, they had no credit score.
No.
So talk a little bit for some of our young entrepreneurs, how to establish, because some of the folks in our food truck program are early 20s, things like that, and they've never borrowed.
Jim's asking, how do younger entrepreneurs who don't have a credit history, how do they go about building credit? And as Jim said, one of the things that he did is he got a credit card for his 18-year-old, and either you can put money on it, one of those prepaid credit cards, you can do that, or you can have, Jim can set it up, put it in his kid's name, and then those reports that start happening, those are positive credit reporting items. Even if Jim's paying it, it's still in their name. It's still under their social security number. They don't know that Jim's paying it. They just know that, hey, these things are being paid. There's also, I said, the prepaid. One of the things that I suggested my nephew do, and I was told that this is one of the good ways to do it. Put $200 to $500 down on one of those credit cards and then start using it, but making sure that you pay it on time. Again, for your FICO score, that's 35% of your score. Even if you've put the money forward first, again, you're getting a positive payment report on this, but you do have to make the payments and you do have to make them on time. Another is when I started out, I was able to, with my mom, I got a store credit. Sometimes your store credit cards are easier to get. It's a little easier, particularly for young people. One of the things that I probably would be very wary of, the minute they hit 18, the minute you hit college, you're going to be starting to get lots and lots of offers. You need to look at those, sit down with your parents, sit down with somebody you trust. Heck, if you're 20 and you're hiring a bookkeeper, sit down and talk to them. What are the terms of this? You don't want to, number one, jump into something that has a huge interest rate, like I'm seeing 27%, et cetera, and make sure that you can actually pay it.
Should they be worried about the high credit limit?
About the high credit limit? Yeah, you should be. The higher the credit limit, if you have a huge credit limit, that they will actually anticipate that you will borrow, that you will use all of that. So if I've got $50,000 in credit available to me through maybe a couple of credit cards, this, that, if I have that capability and it's too big, that will count against you as well.
Oh, risk.
Yes, it's all about the risk, and how high the risk goes, the lower your credit score. But again, it takes a number of factors. I'll tell you what you can do. You can go to one of those websites and it will tell you chapter and verse, what makes up the typical score. I just use the FICO because it's the easiest to access. But I know that 35% of you paying on time. The mix of credit, accounts that you have.
Installment and revolving.
Yes, and how many are revolving, et cetera. So, it all goes into that, but that's one of the first things you should do. And you should start working on that a year before you start planning your business. Would you agree or disagree, Harold?
Yes.
Yes, he agrees with me. Yay. Because it takes time and it takes some self-control to be able to do that. The younger you are, the harder that is to do. I've been there, I've done that. But starting out a year ahead of time, that gives you time to build up that credit score. And again, if you're going to borrow money, the higher the credit score, the less your interest rate is going to be, the lower your interest rate. And so the less ultimately you're going to be paying for that loan. Yes.
Another thought on source of owner equity for doing these things that I've used is cash value, loan value of life insurance policies, whole life policies, because they're typically on low rate of payback with no qualification process and to get the money within about 5 days.
Yes, he was talking about using a life insurance policy,
Like,
whole life. Yeah,
cash
whole life.
value, whole life loan value.
That you can use that loan value as a source of equity. And a lot of lenders are now requiring that, particularly if it's a business, maybe an LLC or a sole proprietorship, even partnerships, they'll require all of the members or the partners to have that type of insurance.
I'm not talking about collateral against the loan. I'm talking about source of funding to do anything.
Oh, you're talking about as a source of funding.
Borrow against.
Okay. My brain was in a completely different place.
Well, I happen to work in insurance. We have 6 kids and 14 grandkids, all of whom have whole life policies. So having that available to me when I moved to Bluefield is how I can finance the upgrades on my house. So it's a great way to do it. Money comes in and nobody knows about it. That's my credit score.
That's good. He was just talking about whole life insurance policies
That develop cash now.
that develop a cash value. You're the insurance expert. I'm still learning about that, but that is the best thing, and it can serve as a source of equity, of cash when you need to use it. Thank you.
Sure.
Again, business credit score, as I said, Dun & Bradstreet has, a free one. For the most part, though, you are going to be looking at paying something once you're in business. You can raise your business credit score by doing a few things. One of the things you can do is ask the vendors and your suppliers that you're already using to start reporting to one of the business credit reporting agencies. Some of them will actually accept some of your financial data, and you can put that on file with them. And that's another good way. So that's just two ways that you can raise that business credit score. When you establish that business credit, now what they're telling us that you do need that federal EIN. Now it's called an employer identification number, but you can get one even if you don't have employees. That was the traditional purpose. Right now, I even suggest that sole proprietors get an EIN. They're also calling it now a TIN, a tax identification number. Many of your banks, when you go to create a checking account, they're actually requiring not only your state identification number, but that federal identification number as well. Now, in some states or counties, et cetera, they'll actually, you'll have their federal tax identification number, and they may model your state or county or local based on that. So for example, in the state of West Virginia, it used to be whatever your federal tax ID was, they would add -55. And then that was the West Virginia tax ID number. That was easy to remember. Again, when you do have that EIN, you can't get a copy of it. So you can apply in paper now, but if you want something that takes about 5 to 10 minutes, irs.gov, there's to your left, it'll be a small business and sole proprietorships and small businesses. Click on that. Not fairly down is EIN and how you can apply for that. The fastest way is online. Again, 5-10 minutes. You'll need to have your birth date, your social security number, and all of that stuff. But once you have that, print that off, number one. And two, save it, print a PDF, save that as a document so that you always have access to that. Because if you lose it, yeah, you can get it again, but it takes a lot of effort. Again, look at the business credit report that you may already have. And again, I think I just said, ask suppliers to report information about you. All right, we're getting towards the end. If you want to learn some more, I really like SBA's. If you're just starting up, SBA has a business guide. I think of it as an overall primer. And as you're doing that self-assessment, it helps you decide, is this something I want to do? There's also a shorter version, 10 steps, but I also like the lean business plan template. And it goes into a little more detail, but it makes you think through, most importantly for me, who's my target market and how am I going to reach them? Because in addition to lack of access to capital, one of the big things that has small business failing is the fact that they'll create a business, but there's no actual need for the product or service. I think that's number two. And I think Harold and I have both seen that happen. And that lean business plan template. And score.org, again, it's one of SBA's resource partners, but they have a lot of templates, including cash flow projections, business plan, et cetera. However, Bluefield State University Small Business Development Center that Harold represents, they also have a business plan template. So it's just go look at these things.
And that's one of the biggest problems that Harold and I run into with working with entrepreneurs, especially in the food truck program. They are scared to death of the business plan. And they have to take our entrepreneurial boot camp, which is online. It has modules on that. We partner with Santa Clara, but that's one of the biggest things, obstacles at the end is getting them to finish the business plan. So, they may want to stress that, we're here, especially Harold, to help through the process. It does not have to be PhD level product that we will help all the way through.
That's absolutely true. Jim was talking about in their food truck program, you were having a lot of young entrepreneurs, but entrepreneurs overall that are afraid of the business plan. It just looks, it looks too difficult. It looks, it just looks too complicated. And you have online your business boot camp.
The Entrepreneurs Boot Camp is online, plus we connect them with Harold or Holly or one of them with the SBDC corner where they live. But, just encouraging them to follow through, and that's vital, because they actually have to have two business plans. They have to have a business plan for the 60 days they get to use the truck.
Yeah.
So then you're not worried about debt or anything like that, unless it's working capital. So you've got that. And then after they're finished with the truck, Harold will take their actual sales to build them a finished business plan versus having projections in the first one. Now you got real sales data.
That's
So
right.
it's actually like you have a preliminary plan and then you have a final updated plan. Is that right, Harold?
That's cool. Yeah. And absolutely go and get that help. It's free. Number one. Number two, it's 100% confidential by federal law. And, these folks are certified, and you've been doing this for a number of years. I've never met, an SBA resource partner that does not have, the experience that they need. Just a little bit more about capital. Again, these are all hyperlinks. And I talked about having more data on establishing credit. Here are some great articles on establishing business credit, how to leverage your business credit, how to improve it, and what you should know about, I like this one, hard and soft pulls. We talked about this, but the Bluefield West Virginia Economic Development Authority has that Entrepreneurs Boot Camp. They also have both live and recorded trainings like this one. And they also have a really interesting food truck incubator program. So if you're in the area, if you're in the Bluefield area, check that out. And of course, Harold with the West Virginia Small Business Development Center, you at the Bluefield State University. It's a lot of language. But here's just some information they have. And one of the things that they've done recently is participated in what's called Business Link. And that's something that you can find articles, templates, etc. And SBA. SBA has not only we have like a West Virginia district office, but there's a district office in Kentucky. There's one in Virginia. Larger states may have 4 or 5, but we're the local boots on the ground folks. And we put everything that we're doing in SBA's national training calendar. SBA also has a learning center dashboard. And if you've got a weird question and you can't talk to Jim, you can't talk to Harold, and it's the first of the month, log on to Q&A with SBA. I've got people from Virginia, Tennessee, and Kentucky, folks like me. And between all of us, there's not very many questions we can't answer. So think about joining us for that. We are a little bit about the Q&A. I do want to show you one more thing before we get to any additional questions. I have included 25 financial or business loan terms that you really need to know. So you can print these out, or that 25 small business loan terms you need to know, that's a hyperlink. So you can just go and read that online if you want, but it will talk about what is an annual percentage rate. How does that differ from the interest rate you might be quoted? And it gives you just a lot of detail, cash flow, the balloon payment. I never realized those existed, but those are nasty things, but they can be. It can be a good thing for your business if that suits the business that you're in. All right. We actually have some questions, but I will tell you, if you have any questions that maybe you're thinking of, or maybe tomorrow, etc., you can contact Harold. You can contact me. We had that in the PDF with our contact information, but also, Jim at the Bluefield Economic Development Authority knows where to find both of us, and we'd be happy to answer any questions that you have. Has anything occurred to you, Harold, that I've missed, sir?
I have a couple of questions. How do you prove equity injection? You talked about they would need to inject some equity into the project, and they will ask for proof of that.
You may have to help me out here, but remember when I talked about the gifts, and they want to see where the money came from and proof that you actually have it. So they may need your bank account statements.
Bank statements.
So they'll need your bank statements. They'll need, let's say someone gave the money to you, they'll want their bank statements, right? They'll often too want, as I recall, they'll want a letter or some communication that definitely says, yes, this is a gift. I do not expect repayment. And I know that when SBA is involved, there used to be like a series of rules to show, you have to have this 1, 2, 3, 4, 5. So it's the same thing. You just need to show where the money comes from and where it is now. It's just like the collateral. You have to have a whole list of that collateral and the current value of that. And they'll often ask, as part of the loan, they'll often require an appraisal. Whether it's land or equipment, etc. If you're a business and you're in existence already and you have a lot of equipment, well, that's one of the things that you may, when you've got a little extra cash, you may want to do, because at tax time, when you're taking, sheesh, I've lost the word, but thank you. That is where you actually need to know how much it cost you at the beginning, how much work you've put into it. Maybe you've added tires to a truck. Keep all of that in a separate file. I had cameras as well, or not cameras, photographs as well. But you may want to have a professional appraiser do that. So if you do have to go after a loan, then you've got that information right in front of you.
Or to also have insurance policies on that too.
Absolutely. Hazard insurance, I know that, first of all, your lender's going to require that. If there's an SBA guarantee involved, we're going to require it, because that is so important. And it should be, I think the last time I looked, up to 80% of the value. Yeah, it just depends. It's going to depend. But yes, there's actually, and you may have to come up here and talk to me. It's one of the things that we don't talk about often enough, but it are the insurance requirements that you have. There's regular business insurance. Then there's, if you have automobiles, there's an automobile piece of that. There's also key man insurance. And Harold, I know you and I've talked about that before. If you're a key person in the business, what happens when you go belly up?
Have a partner that goes belly up and get it all settled.
Exactly. It's particularly important when you have partners.
Or a death.
Or yes.
Yeah, because we use the example that if Harold and I are partners, then all of a sudden if I die, he's got a new set of partners.
Whether he likes them or not, and vice versa.
My children and things like that.
That's right. That's right. When other people are inheriting a part of the business, whether a partnership or an LLC, as a membership. And you can though write those operating agreements where that does not happen. It's just like the last man standing or the last woman standing. But if I'm going into an LLC or a partnership with someone, I'm going to be thinking about, my heirs, and I probably won't do that. But if you do nothing else, make sure that you do have a solid operating agreement. And I'll tell you where you can pick up a template that I've been sharing with a lot of folks. SCORE.org. It's just SCORE.org. It used to stand for Service Corps of Retired Executives. It's sometimes senior level people at companies who've just retired. They have different expertise. You may have someone who was expert in business, let's say in food production, et cetera. And you can actually, wherever they are in the country, you can actually get them as mentors, but they probably have one of the best sources of information that I have seen online. So you can go in there and find white papers, those templates I talked about earlier, but just, anything that you need. And one of the things is a template for an operating agreement. And then beside that is 50 things that should be in your operating agreement or that you at least need to think of. So before you even start your business, if it's going to be with someone else, and I'll tell you a personal, never go 50-50 in with any business. Because if somebody decides, I'm not going to work, you can't make decisions if you're only a 50% partner. So make sure one of you is 51%. Oh, you talked about the complexity of the business plan. I did want to come back to that. It used to be more so than now is that people would subcontract that. They would hire a company and full of PhDs and, we've got all the research for this done. And I've seen people pay up to $10,000 for somebody else to write their business plan. The problem was, there's two problems. One is that it's not detailed enough often. It doesn't reflect you and how you're going to operate the business, right? And okay, it's expensive. And the research they're using is probably not geographically based. So they're just going to, likely use an article from here or there. And it used to be as well that business plans were a lot longer. Now, Harold, I'm going to guess 15 pages. 15 pages, and they get to the point. Don't put in a lot of flowery language that you do not need. This is in thous and therefores. Make it straightforward because lenders are busy. There's actually fewer of them, and they need to be able to get in there and do it.
We actually looking at each other smiling because doing one recently that we even checked the chat GPT and AI to see how it's created. It's so generic. You all you do is replace the name of whatever community it's
Yes.
Bluefield or wherever. And the problem with that is a lot of people don't realize you don't have to have a business plan if you're self-funding.
Yeah.
However, if you don't have a business plan, you're not setting goals and objectives for yourself. And I know a gentleman that had done extremely well, told me about 20 years ago. Every year on January 1st, he wrote a list of things that he wanted to accomplish that year in his business. Simultaneously, he opened the envelope from last year to see if he met the goals that he set for himself last year. And I really like that idea.
I like that too.
Because the difference between a goal and reality is a timeline.
Absolutely. And let me underscore too, if you're self-funding, you don't necessarily need a business plan technically, but as Jim said, you need it. You've got to have it because things can go wrong. I'll be honest with you. My family business started in the late 60s. The business plan was in my grandfather's head. And when he passed away, everything started to fall apart because there was not anything in writing, or there's nothing solid that those who were left over could depend upon. So always have that, even if it's, even if you're self-funded, and even if it's just, as Jim was saying, a list of here's the things that I'm going to accomplish. But don't do a business plan and put it out on the shelf someplace. You need to be able to use it because you may need to pivot. Let's look at COVID. Let's look at all the businesses, restaurants as an example, who were sit-down restaurants. They had to pivot and do curb service. They had to pivot and create drive-through windows. So, I mean, that is critical. Also, we talked about the templates, the business plan templates, et cetera. You can actually purchase or access through Small Business Development Center business plan templates that are based on, here's a business template for a restaurant. Here's a business template for, that's only a starting point. That's just to say, here's how somebody else did it. This is kind of generic. Now go out and make it your own. You need to make it your own. It needs to reflect everything that your business. And again, SBA Resource Partners, Bluefield Economic Development Authority, those folks have that information. And one thing that you have, Harold, I know the West Virginia Small Business Development Center is you guys use a data company. I don't think I'm going to name it, but I've seen some of the reports that tells them if you're going to start manufacturing your own beer, small beer, what kind of, is it going to be a dark? Is it going to be IPA? What's the future for that type of beer? What is the profit margin that should be in that type of business?
Actually have two of those companies.
You're using two. That's great. So if you can get, and if you went out and bought that report yourself, what, $1,000, $1,200 at least? So get in his pocket. Anything else that I've missed?
I have one more question. You mentioned leasing as a way of financing. Is leasing tax deductible?
Yes. That's a big, I just couldn't remember whether you got a credit or a deduction for it, but yes. To me, I came from a construction background and everybody was old and we thought we have got to own this and did a lot of finance leases. But the thing is, if you've got a John Deere and you're out of business, let's say January through March or December through March, it's sitting there doing nothing. And you could, with an operating lease, being able to deduct the months that you were operating, but still have access to that. So especially if you're trying to bootstrap it, starting your business, don't purchase equipment, lease it until you find out if you're actually going to need it as much as you think you're going to need it. You can lease computers now.
And even on a small scale, you mentioned earlier about, I think it's with the UCC, where if you're buying a business from someone, you need to have somebody check because what you think you might be getting is not an asset that's part of the business or making debt. Yeah.
Absolutely. If you're purchasing a business, one of the first things you're going to go to your Secretary of State's office and look to see if there are any UCC liens filed against them. Number two, you're going to want to have a business valuation. I would. You also are going to want to see their last 3 years tax returns because sometimes things don't, you've got a lot of tax accountants who say, we want to owe no taxes at the end. That's not good when you go after loans because then the lender can say, well, you didn't make any money. Why should I be supporting your business? So everything that a lender should be looking for, that's something that you should be looking for as well. We also see a lot of businesses sold that are self-funded. So let's say the owner, okay, I'm going to sell this business $100,000. Somebody can say, well, I don't really have, I can't get a lender, but I've got $15,000 in cash. So that business owner can sell on a month-by-month basis, just like, people can rent to own things. You can rent to own a business. It's important, though, that you get everything down in writing and that it is very clear. Now, if you're on the other side and you are the purchaser, just beware that that owner is going to be up in your business until they're completely paid off. Another kind of rule that I saw is think about if you are going to self-finance the sale of your business, you just make sure that they have as much money down as possible, at least more than 15%. That number may be a little low, but.
Flip side on the long-term payoff of selling your business to someone else and the pay by month things, they can tank your whole business and go out, they can bump it all.
Yes. Yes, I've seen that happen. Now, the other thing that you can do is there's a business purchase overall, but there's also just an asset purchase where you want just all of the stuff that they have. But make sure that if you're doing this and you want to continue this on, make sure you get their customer list as part of that. Consider that part of the assets. So make sure you get that.
How do you value this? Just because somebody was a customer in the past, it's not being to continue.
No.
How do you value that?
There's a term of art. Harold, can you help me with this? that I'm thinking of, like the Goodwill.
Okay.
Yeah, Goodwill. And I'm not sure how they do it, but the lenders, again, prudent lending practices, they have some formulas that they'll use. But yeah, Goodwill is worth so much. I can't remember what that's based on right now, but I will look that up.
They do discount. Like she said, they have formulas, but they'll take the monthly sales and then they'll discount that.
So Harold said they'll take the monthly sales and then discount that like they would physical property.
Yes.
And along with our entrepreneur boot camp, we also have a boot camp for existing businesses that are trying to scale. For example, there's a class, a module in family succession planning, there's some in buying franchise, selling a franchise.
Yep.
Different things like that, that helps them vertical integration, growth by duplication. There's modules to help an existing business to go to the next level, because sometimes you get in that little plateau, it's kind of hard to get out. So
It really is. I was just telling the story about what happened when my grandfather died, who was the head of the business, and that succession plan was not in place, and it did not go well. But even if you say you're selling, you need to figure out how to get out of the business at the end. Now, a lot of us, I'm going to be in the business till I die. Okay, but that's not always reality. It may be that my bum leg means I can't go out and work on these diesel engines anymore. So it may be that you need to have a retirement plan in place, and that should be part of your succession plan. And who's going to take over? Are you, is it going to be family? You need to be thinking, how ready are they to do that? Number one. Number two, be nice if they had some cash to put towards it, because we want them to have some skin in the game, right? So that all comes into play. But succession planning is it's critical. Even if, for a business, let's say I'm 45, you should still have a succession plan, because something could happen to you.
One thing you say in insurance business is what happens if you leave the business or the business leaves you. You gotta cover both cases.
That's true. Like I said, in the insurance business, what happens to the business when you leave the business or the business leaves you?
Right.
I like that saying. Some of this is going to depend too on operating agreements and all that stuff. I'll just throw this out there. It's going to be on your legal organization. I've been very particular about using LLCs have members, partnerships have partners, C and S corporations have shareholders. And those differences matter when it comes to not only how you pay yourself, but how you access lending, et cetera. And so I should just say that with limited liability companies like the S Corp, the C Corp, the LLC, and not really, to some extent, the partnership, not a full partnership, but limited liability partnerships, it creates a corporate veil, and that corporate veil creates a division between your company and your personal assets, whether there's one or two of you or three or 100. And the thing to remember is that you can pierce that corporate veil very easily. You use the company's assets for personal use. You create crimes using the company. It can be as simple as, misusing company resources. That can be, hey, I'm going to send so-and-so out for my dry cleaning. You've pierced the corporate veil. Now somebody has to prove it. The easiest way to prove it, and the people who pierce the corporate veil most easily, are your lenders, because they're going to ask you, they used to ask you to sign twice. You're going to sign as, hey, Kimberly Donahue, president of Acme Corporation, and then Kimberly Donahue, guarantor. That's the word you're going to hear. And that means you're personally guaranteeing that loan. And I know that when SBA does loan guarantees, they ask for just that you guarantee that in both the capacity as the business and your personal capacity.
Jim, I want to thank you.
I got one more
Oh,
thing.
I'm sorry.
You also mentioned gifts as a form of equity injection. Tell them to be careful with that, because if someone gives them money, it has to be in their bank account a certain length of time in order for it to be.
I'm glad you said that. Thank you. If you do receive a gift, we told you need to see the process, but it also needs to be in your bank account for a certain period of time.
Yes.
60 days, 90
60
days, 60 days. And that,
So it's not a fraudulent transaction.
yes.
Right.
And if you're an existing business right now, or you're starting up in 2024, there's something you need to be aware of. Beneficial ownership information, BOI. And it's to prevent money laundering, terrorism, money laundering, et cetera. So every business that was in business before 2024 has until December 31st, 2024 to report who actually owns their business. Okay, you have to have their address, social security number, et cetera. It is they tell us that it's a completely, it's a safe system, and not everybody can look at this data, but it has to be done. If you just started your business in 2024, you need to do that sooner. I think it's 90 days. And then in 2025, it goes down to 45, et cetera.
Is that, how's that business owners being notified of that? Is that an IRS thing, or is that?
It's not an IRS thing. It's actually through the Department of Treasury. And it's through FinCEN, Financial Center for, I can't remember the rest of it, but yeah, if you put in beneficial ownership information, et cetera, they're doing trainings. They did one for SBA. I know we're mentioning it in a lot of our stuff. They've told us, I haven't seen as much as I would have liked to have seen personally, but they tell us that they're going to be doing a bigger push. But the data, my understanding, not everybody can see it, but the data is secure. And, but again, it's just a way to cut down on money laundering, et cetera. The banks are already doing this too. So you can't, if you sign up for a business bank account, they want not only your federal tax ID, they want your social security number as well. So again, it's all about preventing fraud, preventing money laundering and that sort of thing. But when you talk to folks, yeah, get on to them about that. Make sure they're doing that. You can do it yourself, or there are companies out there for a fee that will do it for you. Okay. The thing is, there are a lot of black hats, bad actors who are sending letters to businesses because it's not hard to get their business, their mailing address, et cetera. But they're doing emails and saying, hey, you're going to get fined $500 a day. By the way, send us all your data. We'll take care of it for you. And then they have your tax ID number. They have your social security. They're even saying they're creating different made up agencies for the federal government. But if you go to that FinCEN, Department of Treasury, FINCEN, and beneficial ownership information reporting, it will actually show you some of the fraud that is happening. I'll give you about 4 or 5 different examples of that. Yeah, everybody needs to look at it, and I just tell everybody, but you can do it yourself. It is required.
Because my wife, it's a full business she's talking about, and I've never heard that. So I know our district office is pushing it. I see some others that are as well, but I personally, you may want to cut this. I would personally like to see Treasury do a better job of getting that information out there. And Jim, did you have any last words for us? No, just thank you. If you have any comments, questions, or classes that you'd like for us to offer, please let us know.
Absolutely. And from Kim Donahue, Small Business Administration, West Virginia District Office. Thank you so much. Thank you, Jim. Thank you, Harold. Thank you, sir, for being here. And I hope to be asked back. Thank you so much. Bye.